Are you able to buy a home if you have bad credit? The short answer is yes. It's probably going to take some work though. The first thing that you have to do is you have to figure out why you have bad credit. If you have, let's say, a foreclosure or a bankruptcy, there has to be a certain amount of time that passes in between those two events for you to qualify for a loan. Depending on what program you're trying to qualify for will depend on how much time has to go by. Now, if you look at your credit report and the reason why you have bad credit is because maybe you have some delinquencies or maybe you have some charge-offs. Maybe there was a period of time a few years ago where you were in between jobs and you just couldn't make the payments. And as a result, you got hit with late payments. So what you want to do is you want to talk to a professional before you contact any of those creditors, because a professional loan officer should help by giving you good advice on how to deal with that. What you don't want to do is just pick up the phone and start calling these creditors, because you can actually do more harm than good. Now, if you have these late payments, if you have charge-offs, the first thing you want to do is to make sure that you start making your payments on time, because this is probably one of the most important factors in factoring in your credit score is late payments. Now, the other thing is that you want to look at is what we call your revolving credit. So revolving credit is a credit card. Let's say that you have a $1,000 limit on a card. You want to try to never carry a balance over 30% of whatever your available credit is. So if you have a $1,000 credit, you want to try and keep your balance under that 30%. Now, you can go all the way up to 50% and it won't affect your credit negatively, but you're not going to get as much bang for your buck as if you keep your balance under 30%. Anything over 50%, like if you're at $600 and you have a $1,000 limit, that's actually going to affect your score negatively. So here's a trick I want to share with you guys that most people don't know about. So when you have a credit card, and let's say the credit card is due on the 14th of each month. Well, what happens is on the 15th or 16th, you're going to get a statement from your credit card company telling you, here's your minimum monthly payment. And, let's say on a $1,000 credit card, you have a $400 balance. And let's say it tells you that you've got $150 that you have to pay. Well, you don't want to just pay that immediately and then turn around and charge more on the card, because what most people don't realize is that when the bureaus hear about how much money you owe that particular credit card company, they're going to know about what your balance was at the time when your statement ended. So if your statement ended on the 14th, the balance that you owe on the 14th is what's going to go on your credit report. So let's say you wait a couple of days and now the 16th rolls around, you get your statement from your credit card company. If you go immediately and start, you pay that off, that particular, whatever that monthly payment is, and then you use that card throughout the rest of the month, and let's say you add on a few $100s onto that card, well, when your statement is due on the 14th, they're not going to report what the balance was when you made the payment. They're going to record what the balance was at the time when your statement was due. So what I try to always tell my clients is to set an alarm for yourself, like 3 days before your statement is due. Take a look at your balance and try and pay down that balance to where you're below that 30%. 3 or 4 days before the statement is due. That way you're going to get a more accurate reporting to the bureaus of how much you owe the credit card company. So, the revolving debt is another one of the massive things that are going to affect your credit. A lot of people are under the mistake that, getting your credit pulled it really hurts your credit. And that's kind of based in truth, but only if you're the type of person who's applying for credit, every couple of months. It's the cumulative effect of getting your card or getting your credit pulled every several months that winds up hurting your score. If you only get your score pulled occasionally, it has the least amount of effect to your credit score. Now, to qualify for a loan, for a conventional loan, your credit score has to be over 620. You can go as low as 580 on an FHA, or VA really doesn't have a minimum, but if your score is under 620, they're going to want some explaining done as to why exactly your score is below that 620 level. So you can get a loan with as little as a 580 credit score, but if you talk to a mortgage professional that really knows what they're doing, they're going to be able to take a look at your credit and tell you what you need to do to start raising your credit score. If your credit is just too complicated for the loan officer to be able to help you navigate through it, they might have a referral for a credit company that can help you to improve your credit. Now, the one thing I want to try and really get across to you is there is a big difference between a company that tries to help you raise your score and one of these credit counseling companies. Anytime a company tells you to stop making payments to your creditors, they are not doing you any favors. That's a tactic that a lot of these credit counseling companies will do so they can try and get you to pay, 30 cents on the dollar, is they try to get you to stop making payments. So then the creditor looks at it and says, well, getting 30 cents on the dollar is better than nothing. The reality of it is you owe that money. The creditors want that money. If you negotiate to try and get to pay off a lower amount, it's going to show paid for a lesser amount than what was agreed upon at the time when you got that credit. So if you could take away one thing from this video, the one thing I want you to really take away is don't try and self-diagnose yourself and try to fix all of this yourself. I would recommend that you talk to an actual loan officer that knows what they're talking about, because they want you to buy a home. They want you to get approved. Even if it takes, 6 months or a few years, they will usually help you navigate to try and improve your credit if they're a good loan officer. So don't try to do this yourself. There are no quick fixes, folks. You've got to be able to do the work to be able to turn everything around. The good news is we've had a ton of clients that we've worked with that have wound up becoming homeowners when they didn't think they could qualify. So don't self-diagnose yourself. Talk to a professional that knows what they're doing. They'll help you to fix your credit score, at least bring the score up, and get you to a point to where you're in a position to hopefully be able to qualify for a home. It's also going to be dependent on your income and, whether it's a primary residence or an investment property. In the last parting words I'll give you is this. Here's what I tell my clients. Don't self-diagnose yourself. If you think you need to save more money, if you think you need to pay off credit card debt, if you think you need to get more credit, a good loan officer is going to help you navigate through that and probably be able to help you. Even if you need money to put down, there are down payment assistance programs. The one thing a loan officer can't do usually is get you a job. So if you've got a good job, but your credit is really, you need some work on it, contact your local trusting or trustworthy loan officer and they'll help you out. All right, I hope this helps you. And don't hesitate to PM us, private message us, or direct message us. Or you can also reach out at the information below. All right, take care, folks.